Recording in progress.
Hello, good evening, everybody. If you all can hear and see me, don't mind type a one. So that at least I know. Okay, thank you for replying. Okay, now it's already 8 o'clock, so we don't wait for the rest. We will just uh continue. Okay, good evening. Thank you for attending today's session. Today we are on module 9. Okay, and today we'll talk about REITs, but it will be REITs for beginner as 2 hours we can't touch too much detail, but I'll try to take out the most important part so that at least when you want to do a REITs analysis, you will know what is going on. And also that if you all have any question along the way, just type on the Q&A side or type on the chat side, then I'll answer to everyone along the way. First, disclaimer, what I share with everyone is for your knowledge and information only. It doesn't constitute any financial advice as everyone's financial situation is different. If you need more specific advice, you can look for us separately on that. And let's go straight to today. We're going to talk about REITs. And what is a REITs? I think this will not be, most of you will be familiar with it, but let me just go through the basic thing as a refresher or to those that really are new to REITs. So for REITs, it is in short, it's called REITs is a short form of real estate investment trust. It is actually a collective investment scheme that focusing on buying income producing real estate. So the key word is income producing and real estate. So they buy properties that able to generate incomes, and income is rental income. That's in short. And they can own many type of properties like commercial real estate, from office, apartment building, warehouse, hospital, and shopping center, hotel, even timberland can be any form. But in Singapore, we only have 6 types of REITs. We'll talk about that later. And how does a REIT form is, first there's always a REIT manager, and this REIT manager will take money from you and me as an investor. And from taking our money, it's still not enough for them to buy properties because property is not cheap. So they will also at the same time, take a loan from the banks and to buy properties. So do take note, REITs don't buy property that are under construction. They don't buy property, they're just TOP. So that's something to take note. They are supposed to buy so-called mature properties. Mature. That means the property have been in operation for years. At least to me is one rental reversion. That's a normal way a risk manager should buy. If a risk manager is aligned with investor, you see they'll buy a property that have more than one rental reversion. That means that the property has been there for a few years because rental reversion take 2 to 3 years for the tenant to renew their lease already continue, because then there is data, and then they'll buy these type of properties, and as it is something like buying a property come with tenancy, so immediately you collect rental income. So this is what a REIT is supposed to do. If buying income producing asset, you don't buy an empty piece of land to build from scratch a property. That's a property developer job. And you don't buy a property that just TOP and no tenant yet, still looking for tenant, then they will buy it. Then they start to look for tenant. Now investor will not be happy. But for big REITs, very big REITs, for example, Ascender REITs, CICT, because they are big enough, they are also able to take in something like property developer role. For example, they can tear down the building and rebuild. Like CICT, they tear down what Funan and rebuild Funan, but it don't affect the risk DPU. So there is a regulation requirement that they cannot exceed a percentage when they want to do that. But then, so only big REITs are able to do that. To take the only big REITs can do that. Small REITs cannot do that. They can't tear down their property and rebuild. The DPU will be greatly affected. But big REITs do that, they don't affect the DPU. In fact, sometimes the DPU can just increase. And so after they collect the rental already, what they do, they need to pay the bank first. Okay. Bank is the creditor. Bank must always be paid first. So they pay back the bank interest. So this is what they do. They only pay interest to the bank. They don't pay outstanding loan. Do take note, a rental income collected, okay, are not supposed to use to pay down loan. That is the in a way, REITs practice or mandate. Not like you and me buy property, take the rental income, we must pay down the loan. That one we got no choice. But for REITs, they are allowed not to pay down loans. And the bank also cannot tell them to pay down their loans. And they don't need to pay down, so they only pay the interest. So rental income less of interest and of course other operating costs, then the balance will be given to us as dividends. So this is why we got cash flow, and they need to pay out 90 to 100% of their income as dividends. So practically, what does a REIT mean? Means that the REIT don't have reserve. They don't have reserve. So if you look at stock payout, like you use payout ratio as an example, for stocks case, for REITs, the payout ratio is 90 to 100%. So how could a REIT got more money to buy more properties or to grow as they have to pay out all the money? So then this is why they need to call right issues or preferential offer to buy properties. And this is a reason that REITs constantly need to call for money when they want along the way. So when you buy a REIT, you must prepare to have money to subscribe to it on that. But if it's a good REIT, sometimes you don't subscribe, you don't really, it will not affect you that much. In fact, your dividend will still go up. But if you buy a lousy REIT, you don't pay, you will suffer a lot. And thus, it is very important to pick the right REITs for that. And this is how a typically REIT structure work. There is always a REIT here with the unit holder and the sponsor. Of course, there's a trustee. Then there's a risk manager and property manager. And you can see that who own the risk manager? It is a sponsor. So the alignment of interest of the risk manager with the sponsor is definitely aligned. So when I buy risk, there's something called alignment interest. It's definitely aligned because the risk manager is employed by the sponsor. How can they don't listen to the boss? Imagine you go to work, you don't listen to your boss, you will get fired. So is the risk manager aligned with the unit holder? That will depend whether the sponsor want to align or not. If the sponsor don't want to align, the risk manager will not be aligned because they have to listen to the boss. So that is one thing very important that when it comes to investment for risk, you must make sure there is an alignment of interest between the sponsor and the unit holder. If there's no alignment of interest, that means the unit holder will be taken for a ride by the sponsor. The sponsor will make a lot of money, but the unit holder may lose a lot of money. And this is a real live example of how a restructure works. This is CapitaLand CICT. And you can see the manager here, the property manager here. Of course, this is a trustee. The one that This one will definitely 100% manage under the sponsor structure. And this is another REIT structure. This is Keppel REITs. This is K REITs. Similarly, you can see the properties and the managers on that. Okay. And then this is the manager, then got board. Of course, here they put who is the sponsor, but the sponsor is Keppel Group lah. So that's understandable from the name. And I need to point out something different, very different between a REIT and a business trust, which create a lot of confusion. Currently, there's only a few business trusts listed in Singapore, but people always get confused. Do take note, this is how a REIT structure work and how a business trust work. So for a REIT, the trustee and manager are different person. For a business trust, the trustee and manager are same person. So to remove the manager, you need just a simple majority for a REIT, but you need 75% vote to remove the trustee and manager. So to remove trustee manager is very, very tough. And there's a mandate for gearing is 90%, 50%, sorry. But for business trust, there is no mandate for gearing. Because it's doing business, MAS cannot impose a mandate onto the business trust because they are doing business. And for the REITs, they must distribute at least 90% of their income. But for business trust, no such requirement. And for REITs, very simple. Their rental income, they call the net property income. After that, of course, they need to pay out at least 90% on that. But for business trust, the dividend you collected are sometimes from the operating cash flow. It's not that from the bottom line. It's not that from the net income. It's from the operating cash flow. So that is very, very different in that. And for REITs, they can only buy properties. For business trust, it's any business. So as long as it's a business. So, but the difference between a business trust and a normal company, normal listed company, like you look at Venture, UMS, Wilmar, all these things is that these are companies are formed by entrepreneur. They start their business, then they listed it, then they continue to run the operation. Okay, for business trust, is a sponsor come in, they want to sell their asset or sell their business to a person. Okay, just as a NetLink Trust is a business trust, it belongs to Singtel. Singtel got the optical fiber business. So they sell it to NetLink, the thing, and then they take over and operate it. So thus the business trust manager are in a way they are employee, they are not entrepreneur, they don't form a company to do business. Okay, they are sort of being employed by the sponsor, appointed by the sponsor to go and do the thing. So they are doing the work. So it is very, very different compared to a company on that aspect. And so do take note how you differentiate a business trust. When you see that they are not doing real estate business, then they are definitely a business trust. But there's two property trusts. One is called the CapitaLand Ascender India Trust and Daxing Retail Trust. These two business trusts work exactly like a REITs, but they are registered under business trust. So there's a big these two are the one that create a lot of confusion, especially CapitaLand India Trust because they are under CapitaLand. A lot of people thought that they are REITs, but no, they are business trust entity, but they try to follow the other CapitaLand REIT structure exactly. The only thing they cannot change is trustee manager is still the same person. And this one they cannot change. But below this part and this three part, they will try to mimic the REITs exactly the same. Even in their report, they also say that they're doing this, trying to do the same. But the top part cannot change, it's different. So that is something you need to take note on that. Ah, okay. I'll uh I'll talk about gearing later. Okay, gearing is the debt over their asset, not debt to equity. Gearing is their debt over their asset. So that is called gearing. What does a 50% gearing mean? Since you have asking me about gearing, I just answer here first. What the mean of 50% gearing means that let's say you got a property of 1 billion, 1 billion property. you borrow 500 million from the banks. So their gearing is 50%. So that is what gearing means. So it's the debt or it's a borrowing over the property values. We don't call equity because this is not stocks. This is REITs, only property. So they based on asset values, the property value, the debt. So that's where the gearing come. So it's debt divided by the asset. So that's how a gearing come in. So they cannot borrow more than 50% of their properties values. So that is a rule, not allowed to. Next, and there's another type of trust, which is a stapled trust. The word is stapled, it means they are being stapled together. And stapled trust is a trust be formed by a REIT and a business trust, two in one. So they are bundled together with REITs and business trust as a one entity, and only the property portfolio side, that means only a REIT part, are bounded by the REIT regulations and have the tax benefit, but the other part not bounded by it because they are doing business. So they follow the business trust rules. And thus only the REITs portion are obligated to pay up to 90% of the income as dividends. So that's how it works. And usually you work under the hospitality trust sector. All the hospitality trusts listed are all business trusts. All of them, for example, CDL Hospitality. Why they need it to be so? Let me just show you this organization. This is CDL Hospitality Trust organization. You can see there's a REIT inside this hospitality trust and also a business trust in this aspect. And it's very crucial for hospitality trust. They need to set up in a business trust category. Is usually a lot of them, their business trust is dormant. That means they don't know anything. For example, they got a hotel property, they rent it out to the hotel operator. Classic example is the OUE REITs. They got the Hilton Orchard, last time the old Mandarin Orchard. So they own that property. They are the owner of the properties. So they rent it out to who? Hilton. So Hilton is the hotel operator that operate that hotel, but the property belongs to OUE REITs. So Hilton need to pay OUE REITs every month rental income, and then OUE will pay investor the income as a dividends. And what happened, touch wood, what happened in one day, if Hilton were to go into financial difficulty, the hotel operator go to financial difficulty, but that hotel is still there. And there's still some of them, the hotel is advanced booking will be still there. Okay, the booking is still continue. So the hotel need to be functionable. If the hotel is not functionable, what will happen to the REITs? Will be very costly. Imagine one whole hotel, not the operator go down, the hotel not in operation. How much would that affect the income for the REITs? The REIT share price will crash. Especially for smaller REIT, like OU REIT, they only got a few buildings, only one gone different. It's very different from shopping mall. It's very different from industrial parks, where shopping mall you got so many tenants. One or few tenants go bust also don't affect you. Even the anchor tenant, like for example, the NTUC, the supermarket decided to move out, it still don't affect the REITs that much because they still got every other shop there. But many hotel operator gone, the whole building is gone. Zero income. And this is why they need this business trust to be there. In case the operator go bust, they will take over to operate the hotel. The risk manager will operate the hotel so that it can continue to generate incomes. During this transition period, or at the same time, they look for another second hotel operator to take over. So it can continue on that. And thus, most of them are dormant until they are required to become active. So a classic example is what happened during the COVID period, where really some hotel really gone. Some hotel operator really gone. And then, for example, CapitaLand Ascott Trust, the hotel operator in Osaka go bust. So they take over to run the hotel. But ultimately, they didn't run on finally. I think they sold off the properties. But at least that period, they can still continue have ongoing. And in Singapore context, a lot of hotel are being used for quarantine purposes. So they got an ongoing business by the government, but the hotel operator also go bust. So how the rich manager take over and operate the hotel and still collect income from the government for quarantine purposes, and while at the same time look for a new hotel operator. So that is why it is called a staple trust, so that it can be ongoing. But some of the REITs, their business trust is active because they are hotel operator themselves. Like five hospital trust, they're hotel operator themselves. So they got their own property, they operate their own property. So they do two business together. So but majority of them is dormant. So that is something that's to take note. That's how a staple trust work and why it need to be there. It serve that to serve the purpose. And what are the different type of REITs that are actually available in Singapore? So first, let's look at this. We call this a industrial REITs. Then we got a hospitality REITs. And we got a retail REITs, office and commercial, healthcare, and then we got a data center. So we got this data center was supposed to be under the industrial category, but it become quite an in thing. We got Keppel DC, okay, with the digital core. Now even Maple Tree Industrial Trust also got a lot of data center there. So and people have a lot of interest in that, so it become a standalone in Singapore context. But some analysts still classify them, lump them together under industrial category. So depend on whether you want to put them together or not. So, but I think the public always view that separately. So then we just take it as a separate data center. Okay. So these are the REITs that's available. First is the retail, followed by the office and commercial, and the hospitality, the industrial, the specialized REITs, which is the data center REITs, and then we got the diversified REITs and also the healthcare REITs. So these are the REITs that is in Singapore context. And one thing to take note why there is this thing called diversified REITs is that, as I mentioned, OUE REITs, right? OUE REITs is a formation of two REITs combined. One is called the OUE Hospitality Trust and OUE Commercial REITs because they are too small. So they want to have economy of scale, they just merge these two together and form the OUE REITs. But would there be a synergy? I doubt so. How a office building and a hotel, how to have synergy? I also doubt so. So sometimes they just merge because they just want to have a bigger scale. Whether got synergy or not, you have to look at it. For example, like Fraser Logistics and Commercial Trust is a merger between a Fraser Logistics Trust, which is a warehouse, and Fraser Commercial Trust, which is office building in CBD area. It's not office building in uh outskirts of CBD, is CBD area. So the risk manager must go to industrial area to look at the warehouse, must go to CBD to look at the office building. And both are in completely different function differently, but risk manager must know two things. So whether it so with synergy or not, that will depend how you see it. But for like Suntec, we know about Suntec City itself. Suntec, of course, got more than that property, but the main one is still Suntec. Suntec got office building, got shopping mall, got convention center, but all are housing in the same complex. Okay, housing, at least there is certain form of synergy, and you see office building and shopping mall are quite related, quite linked together one. So at least there's more synergy in the aspect. So this is why when look for risk, even when a big, then they are called diversified, you must look at their business. Do they have really that form of synergy linked to them or not for this aspect? And also you need to also look at the geographic distribution. Uh, if the risk of five property, but all five property are at different country in the world, okay, different country in the world, how to have synergy in that, or how does a risk manager going to measure every time travel first class or business class to go and visit the five, six different country in the world just to see that one property there? And how are they going to compete locally if they have only one property? So that's also another thing you want to look at. So when it comes to REITs, that's another key part you need to take note of. So let's look at this. So what does retail REITs that is available now in Singapore? We have this thing called BHG. For those not aware, BHG is a shopping mall REIT all in China. So it's 100% China REITs. We got Lippo Mall Trust, it's also 100% Indonesia REITs. United Hemisphere is 100% US. Okay. Salsa REIT is 100% China, but outlet mall. Fraser Centerpoint is 100% Singapore. And Star Hill Global is Singapore focus. They got property overseas, but they are still the main Singapore focus. So you can see the REITs, the retail sector, there are actually 6 REITs. They are actually different place, and thus it's very hard to compare that. Is Fraser Centerpoint better than BHG? You can't compare that because they are at different place. Environment is different. So that's how a retail risk is currently looked at. But in general, you need to look at certain things to take note. Retail risk, is there an oversupply of malls? That's a common question you ask. Then the question you need to ask back is, which country are you talking about? Which country are you talking about? So a lot of people always think of Singapore context. Okay, which country are you talking about? Is shopping mall a must to have, or is a shopping mall is a redundant to have? So you need to look at the country aspect. For example, Singapore, I don't think we have shortage of shopping malls. That's my take. Singapore is so small and so crowded and so hot. And where can we go? Shopping mall. One weekend, and shopping mall and transform themselves to be a more education center. Every week I will need to go shopping mall because I need to send my children for enrichment course, and I need to go shopping mall. So just like my wife just come back from United Square with my son. So that's a shopping mall. Weekend I need to go to West Coast Plaza. That's also a shopping mall. Because my son have enrichment class there. So depend on where you are talking about. But you are talking about US, that will be different on that aspect. And what about the impact of e-commerce? A lot of people say e-commerce will affect shopping mall. Do you think it's really affect on that? Almost every day there's delivery to my home. I don't know what my wife buy. Okay. Children thing, her thing, my thing, everything she does online buy. Sometimes I go to shopping mall, my son say want to buy that toy, then we'll check. We go Taobao buy cheaper, exactly the same thing cheaper. So in the end we go shopping mall, see the price, never buy. But we still buy in shopping mall. So that depend on that. So shopping mall will have also need to be transformed. So gone over the day, you will see a lot. Most of shopping mall don't really have the major departmental store there. All are more smaller store, and you can see that they start to transform themselves. And a lot of F&B in the shopping mall. So is there an impact? To me, that as the impact is not really there, as long as shopping mall know how to transform themselves on that. And of course, the stickiness of the tenant, high turnover rate. And of course, then we look at the role rental in proportion to sales, and also most important is, can you increase the rent? So this is what we want. And are they able to enhance the shopping mall to do constantly we call as AEI, asset enhancement? So that is something to think note. And this is what we want to look at for shopping mall. There is a growth of disposable income. That's especially for Singapore. Singaporeans have become richer and richer. There's more money to spend. Not only Singapore, like China, a lot of middle class growing, India, a lot of middle class, and tourism arrival. That will depend on which part. We just use Singapore as a context. If you are looking at suburban mall at Centerpoint, Got tourists, no tourists don't affect them. But look at shopping mall in downtown area. Got tourists, no tourists will affect them, like Ian City. Okay, branded group Paragon, tourists or not will affect them. So that will depend where is the source. And increase in international brand. I think that one is everywhere I can see. So when you want to read a retail, you need to look at all this and part on that. You asked me that of the retail REITs, which one would I look at it? First thing, I'll not look at China. I will not look at these two. This one outlet mall have been growing. Actually, Chelsea have been doing quite well, but if I have a try, I'll of course this one I forget about it. And this one I also not so keen. I'll mainly only look at this. This one to have a bad, to be very honest, have a lousy track record. And thus, in the end, you ask me to zoom in retail REITs just based on this. There's only one choice to look at is Fraser Centrepoint, which have proven that you have a very good track record and is a sour more. But would there be challenge for this REIT? Definitely there is. First is the RTS coming in, and you will definitely, I would think you will affect Causeway Point. That is one of their important reads for Fraser Centrepoint. And it just happened to be at Woodlands. It happened to be at Tampines. I don't think the impact will be there. But it happened to be at Woodlands. So that will be one of the factor will affect Fraser Centrepoint and see how they're going to tie around. And the other one, nearer one is Yishun North Point. Yishun to Woodlands also not that far. So and it's also one of the big key shopping center for Fraser Centrepoint. So that is their challenge they will face. And next thing is growth prospect. Singapore, as I mentioned, is very small. Is there any chance they can build big shopping mall in Singapore going forward? Currently may not have. Tengah area, will there be a big shopping mall, the new housing development estate? I don't think so. So then there is a growth limitation of Fraser Centrepoint. How are they going to continue to grow? So that's another thing you need to consider on that. Can they grow in future? If they cannot grow in future, what are they going to do? But next 5 years, it is still, to me, it's still quite good in that aspect. So that's how you can look at the retail risk in that sense. CICT got retail too. I'll talk about CICT later. Okay. So now I just talk about individual category. So now let's look at office and commercials. So office and commercial is quite straightforward. It's talking about what? Office building. So you got these three. It is 100% US and suffer a lot. This one is 100% UK. And this one is in Europe. This one is 100% Europe. And this one is Singapore focus. That means the main part of income is from Singapore focus. So these are the office. So in a way that you want to you can compare these three, they are all US. But you cannot compare Keppel with Iris Keppel with UK because they are different. Even Elite UK and this one also not comparable. Not comparable because they are at different place. So in the end, they are more of an independent aspect. And what does we look out for office building? And you see, it's quality. I said office building are key one, but ultimately it's still location. Okay, and two things, office are more volatile than shopping. Office are more volatile, especially downsize, and capital expenditure can be quite high. As you are office in CBD area, you of course want to make sure your office look nice and good. Cannot look lousy. Okay, your lobby walking must be nice, and all these are money. Money to take to all this need to spend a lot of money to upkeep it compared to industrial building. They cannot really bother about so much. But office, you need to really take care. And a lot of people say, let's just look at Singapore context. Singapore is small. So number of office building also can be done in Singapore also limited. And thus office supposed to have to be good in the aspect. So just now we talk about Fraser Centrepoint, someone say CICT, right? Yes, CICT got retail. So that is a direct competitor with Fraser Centrepoint. But what about Keppel? Who is our competitor? Actually, it's also CICT. But CICT also got office building. In Singapore context, you look at office building, actually there are mainly two competitors, CICT and Keppel. And you look at the track record of both of them, actually CICT perform better than Keppel. We'll talk about that later. There's also a reason why they perform better also in the way. So this is on the office side, but in general, I'm personally not really keen in buying just the office REITs of all the REITs choice because of the nature of the site, higher cost, capital expenditure, and also they are resulting in very business cycle on that. And with the work from home now like become a norm, a lot of offices are downsizing. And this actually put pressure on office building. Although we can see that we have Singapore, for example, Singapore, we are invited or a lot of international brand like a lot of China, Alibaba come to Singapore, set up office, all these things. But ultimately, the office space requirement have become lesser. And from Philips Security, maybe I just share with you over the years, Philips Security actually offers many floor in Raffles City. Okay, many floor in Raffles City. There's under CICT. But over the years, Philips Security have cut back the number of floor they use in Raffles City. Okay, cut back the number of floor. But Philips Security is still making money. It is a company, I think, more than 50 years never lose money in a single year. Okay, and he's making more and more money. It's not that profit stream, that profit still grow and year. Okay, but why it cut down the office? As they start to move out the back end to the first to move the back end out to industrial area. All the back end staff, all IT staff are no longer based in Raffles City. They are all based in Aljunied. And in fact, they expand the Aljunied site initially, but one floor of the industrial building in Aljunied. After a few years later, they buy another floor, not rent, buy freehold. So two floors, so they can put a lot of stuff all over there. And thus they cut down the office space because they feel that not necessary. And even the office in Raffles City, they also transform to become hot desking. I mean, the staff also don't have a seat in hot desking in this aspect. And because some of them can work from home. And thus, this is how the thing shrink in certain aspect. And a lot of companies have to practice that. And thus, it can be quite challenging for office side going forward as work from home become a norm unless say that everyone must come back from home, must come back to office to work. So this is why I don't really like office building in the aspect. Okay, next let's talk about hospitality trust. So these are the hospitality trust. Far East Hospitality Trust is 100% Singapore. For those not aware, this one is 100% US. Sorry, I don't know how to pronounce this name. That's why I call ARA. ARA. So this is a global. This is also sort of global. This one is only a few hotel around. I think they try to delist. So this is a site. And just for your information, size, when it comes to investment, size really matter. Of all these hospitality trust, if you were to add these four together, they are still smaller than this. Smaller in terms of market capitalization, smaller in terms of total number of properties. I mean, number of property they have, four REITs add together still lose to CapitaLand Escort Trust, one REITs. So it is not a really it's really not really a equal play in a way that this one person can beat four person. So that's how so you can see that some of them are really so small and so tiny. And so the people will look at gateway city. So gateway city, when people talk about tourism, say, oh, tourism come back, COVID come back, Singapore will be good. Then to buy hospitality trust. But do think now that only five hospitality trusts, all their property are 100% in Singapore. So tourism come to Singapore, benefit who? Five Hospitality Trust. You don't benefit Fraser Hospitality Trust. You don't benefit the other hospital. I don't know how to pronounce. You will benefit CDL because CDL got a good percentage of Singapore hotel there. You'll benefit little bit on Capital Escort because the Singapore weightage is, I think, not even 20%. So sometimes you need to look at, oh, tourism good doesn't mean all hospitality trusts can buy. You must look at where is the property located. Okay, where are the property located? So that is similarity for visitor growth on that. So that is something to take note on the hospitality trust. And hospitality trust is an asset class a bit unique on that is that they got different type of income structure. They got income structure and you see that income is not stable. The income, that means if you're looking for stable cash flow and dividend thing, because of the nature of hotel business is very seasonal. You can see when peak period, hotel charge higher rent. Off peak period, the hotel charge lower rent. Just like for example, you go to Dubai. You go in the peak period, there's a winter period or spring period, the hotel can be very expensive. But I go in the summer period, I think the hotel is can be more than half the price. But nobody can go there. Too hot, 40 over degrees. How to go there? Who will want to go there? So you can see their income will fluctuate drastically in there. And thus very hard for hospitality trust to able to deliver a stable dividends in that aspect due to the fluctuation of the income. And they need to pay out 90%. So if good peak season they earn more, they pay out more, then low season pay out less. So the fluctuation will be there. And thus we need to see how are they going to stabilize that thing on this. And for this, one of the risks that done very well in trying to do that is actually CapitaLand Escort Trust. They able to done well in that aspect is that they try to diversify of things in uh, for example, hospitality trust, you see there are several asset class. The first one is called hotel. A lot of people always think that it's hotel. Okay. But hotel, how long you stay? 3 to 5 days. Next is what? Service apartment. Service apartment, you may stay them for months. So this will make the income stable. After that, what they do? They do rental housing. What do you mean by rental housing? They buy a house to rent it to the local and the local stay there and use it for years. And will happen in Japan. And which why Japan there's residential REITs. People just buy property and rent it to the local. And plus another one is PBSA. So for those who don't know what it's called PBSA, it's called Purpose Built Student Accommodation. Or you can say the hostel in a way. So you see a hostel can stay about three years. So from a fluctuation bin of 3 to 5 days of rental income based on peak season or off peak season, they try to transform it to longer and transform it to stable income. So but all these are considered hospital trust. So CapitaLand Escort Trust got all the four assets. Got all the four assets, the rest don't have. The rest don't have. One of the key reason because of size. One of the key reason because of size. But ultimately, to me, if you ask me, should I buy Capital and Stock Trust? I think the stability is still not there yet. But to me, it's for good tactical allocation rather than a long-term allocation at this juncture. So that is my take on the hospitality trust for this. Ascott, its share price doesn't move at all since post-COVID. Yeah, it doesn't move at all. Hospitality trust don't really move. So which why I say that I will only take it as a tactical rather than a main play on that aspect. I don't think they will share placement. For retail investor, I don't think they have really got share placement for retail investor. So far, I have not subscribed for any Escort share placement before. But if they will do it for private, yes, but you see, private placement is okay. Actually, private placement is definitely better for retail investor. So that one later we got time we'll talk about that. Okay, the next is industrial REITs. So there's only one pure play in Singapore industrial REIT. This one, Sabana, and this one run into issue already. You can forget about them already. Forget. And this one only do logistics. This one only, so you can see even industrial category is still very quite diversified in a way. This one only do developed countries. US, UK, Europe, and Singapore. This one try to tweak themselves to data center. So their thing is they have data center overseas, and in Singapore they have industrial buildings. So they try to transform. So what actually have happened, you have seen how Singapore market have developed is initially the risk all start with Singapore. This one start with Singapore. Ascendant risk also start with Singapore. CICT Capital Mall Trust also start with Singapore. But over the year, they start to go overseas. Why is that so? Because Singapore is too small and the risk need to grow and they need to expand overseas. And then indirectly, they expose themselves to a risk that you don't see before in the past. And then the dynamic of the industry has started to change, especially post-COVID. A lot of things have changed. A lot of way have changed. So some of the risks are still transforming and still adjusting, and interest rate is still come down but still remain on the high side, and a lot of risks are still not performing. In the aspect they are still trying to move around on that. So this is all the risks. But if ask me if I will want to invest on all the risk sector, and there's only one sector I can invest in there, I will buy industrial REITs over the rest. If there's only one risk that I need to invest or one sector I can invest for it, then I'll choose industrial REIT. Why is that so? Is industrial REITs, okay, as the whole world economy need to grow, no matter what happen, we still need industrial. We still need industrial. You look at COVID, work from home affect what? Office building. But will it really affect industrial? Industrial, you need people to be there to operate the machine to do that. That one cannot be done at home. Only the admin staff of course can work from home lah. But the rest cannot be done, must be work from home. I was an engineer. I worked as an engineer for 10 years in a power plant. I was a power plant engineer. I build power plants and I maintain power plants. So I cannot imagine you ask a power plant engineer to go and work from home. How to work from home. And when there's emergency, ask me from home, go and travel down to troubleshoot the power plant. It's not possible. I need to be there physically, so the response time can be faster. So industrial will always be there, and no matter what, it is required on that. And task, but we need to look at things have started to transform, especially for industrial. What are we looking at? So one thing we are looking at is logistics, e-commerce. E-commerce will continue to grow no matter what. You like it or you don't like it. E-commerce will have to continue to grow. And e-commerce have been so advanced. Okay, so advanced. So if they need a lot of place to keep their goods, and warehouse is the one that will continue to grow. So you want to look for industrial, we make sure there are this. Another part is business part. Okay, but business park, some of them are not really performing that well. And actually, it's a weaker link among industrial now. Like even it affects Singapore, it also affects US. But it's still the key thing. And next, we call a high specification industry. This is usually referring to the semicon, precision engineering, high-tech buildings. Where Singapore got all high-tech buildings and data centers. So we are looking for this. We are not looking for those OJTT flatted factory, that type of industrial buildings. Okay. If your REITs have a type of thing, I think you don't buy that type of REITs because that one will be obsolete. So these are the sector we should focus on when it comes to industry. See what are they buying? Are they buying warehouse? Are they doing business park? Are they developing data center? Or are they doing high-tech industrial buildings? So this is something that you want to look at rather than say that they tell you, oh, they got a lot of Kallang, a lot of JTC flatter factory on that. What 30-year lease, all these things. So look for all this for the industrial aspect. And also the industrial is also the property value, the property for the building is cheaper. Or uh, can I say cheaper? It's lower cost compared to buy a office building, compared to buy a shopping malls, compared to buy a hotel or hospital. So the number of properties you expect from an industrial REITs have to be more than the number of properties uh, retail REITs, commercial REITs can give you. You need to expect that. You don't buy an industrial, they tell that they only got 5 industrial properties. I think it should not, it should, you should buy an industrial REITs that tell you that I got 100 industrial property. I got 150 or 200 industrial properties. That should be the size you should look at when you want to look at industrial REITs. 20 is very little for industrial REITs. Okay, so because of their capital outlay for that, so that's something you need to take note on. And numbers play a part when that because economy of scales. Okay, next is healthcare. And it itself is defensive in nature. So there is no need to say we have seen what is having going on. And another thing is aging population. Aging population. So that is where healthcare need is more. And thus Parkway Life, it is one of the few REITs that have been having an increasing dividend play over the years. And for those that are not aware, REITs have been doing right issues, all these things, right? Parkway Life have never called for a right issues since IPO. So you can be quite surprised that Parkway Life had never called for a right issue since IPO. And it's more than 10 years. A lot of people say REITs will ask for money, right? But Parkway Life never asked a single cent from investor since the IPO until today. So why is that so big? And also explain why because Upper West Side never grew until that big because I never asked for money to grow that big. But they still can continue to grow without that. And one of the key part is that because of they are fortunate to own hospital in Singapore. Compared to First REIT is not so fortunate. Own hospital in Indonesia. So this is what happened to Parkway Life on that. And however, there's a big concern on healthcare sector is if Parkway Life were to grow, they need to buy another hospital. And everyone is expecting them to buy Mount E Novena. And however, because of their size, they are not able to afford to buy Mount E Novena. They are not able to afford to buy Mount E Novena. And if they were to buy Mount E Novena, they need to call for right issues. And not small right issue, it's quite a massive right issue for them to buy. And this is why up to today, they still never take action. Still never take action because they need to wait and look at the impact of calling for right issue to buy, knowing the winner, how are they going to move forward? And so that is what Parkway Life is. But ultimately, it's still very good in defensive nature, and because we are aging population, we know the medical cost is very high. You look at your shield plan premium, you'll know how much the hospital can make. And thus, I think they can afford to pay the rent. Okay, next we look at diversified REIT. So these are all the diversified REIT currently. And this is the one that when there's a retail and there's an office. Okay, this is a pure China play. The China REITs in China have been affected quite badly. Okay, and they also know that China shopping mall also very bad. I think they got foresight also. They know that China. You look at BHG, very bad. Daxing Retail Trust go underwater already, and they try to transform to industrial, but unfortunately, industrial also got ghost town, ghost industrial park already. So they are still suffering, and this is why Maple Tree Logistics Trust was also being dragged down, where they got 20 to 25% weightage in China on that. And Mapletree Pan Asia is also a merger of the REITs is to rescue Mapletree North Asia Commercial Trust. Then they merge it together, and in them both sing together, and up to today still can't recover because Hong Kong is not really that doing that well, and China also is dragging them down. Plus, the Japan property is not that ideal. So the one that make them still move around is VivoCity on that. So this one is formerly known as Conwell, which I don't have good impression on their REITs last time. Now they change to this one, which I also currently I got no comment. It's too new to comment on that. To me, it's change the sponsor is considered like a new REITs. It's just a new IPO REITs. So can't comment much until when we see how are they going to perform in the next few years on that. Okay, all sponsors will tell you they committed, but after a few years, you see they just change. And they say due to what restructuring or rechanging or strategized plan. And Lendlease, a lot of people like them. I don't understand why a lot of people like them. Okay, I don't understand why a lot of people like them, but just to be careful, the financial of this REITs is not strong. It's just that we are fortunate to have property in Singapore. Fortunate to have 313, fortunate to have GEM in Singapore. If 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 their property is not in Singapore, I think they'll run into issue. So this is currently Lendlease is. And next we look at specialized. We got these two, Keppel DC and Digital Core, and we got one more going to join them soon, going to IPO called the NTT data REITs. So we will have 3 data center REITs in this data center aspect. Of course, you need to add in Mapletree Industrial Trust, which is actually also a data center risk on that. And you want data center also, CapitaLand Ascendas also got data centers. Also got data center in them, and it's quite not small for them because their size is big. So as I mentioned, when a country grows, right, the risk will need to grow. And then there is this thing called cross-border. So when you're buying a REITs that have properties overseas, one thing you need to take note is the risk, the currency risk, supply and demand dynamic, and the political risk, geopolitical risk. And thus, when you look at risk, one of the things is the yield on that is that if I were to have one REIT that is a lot of property in Singapore and another REIT have a lot of property in overseas, both are equally good. That means the manager, the sponsor are all everything is on par. But when I want to buy, I want to make sure that the overseas one give me a higher dividend yield compared to the local one. Then I will buy. If both are the same, then the overseas one, you need to demand a higher dividend yield due to a lot of risks. One of the key risks is currency risk. One of the key risks is currency risk. So that is something that you need to think of that. You buy those listed in US, they pay you in USD, you have to buy in USD. So we are exposed to currency risk. What happens if USD were to drop against Sing dollars? They tell you they can give you 7.5 dividend yield, but that's in US dollar term. But you are taking it in Sing dollar. So how can they ensure that USD will not go down against Sing dollar? Nobody can ensure that. So we are taking that type of risk, and thus you need to demand a higher returns and also political risk. Going to China, who nobody know China how suddenly become property slum, supposed to be growing. So you're exposing yourself to that type of risk. Go to Japan. How come in Japan yen plunge? So you need to have a higher demand higher to mitigate your risk on that. Don't buy things that are same dividend yield for the same company. Then you should buy Singapore. So that's how when look at risk on the cross-border side. Okay. So now it's 9 o'clock. We just have an introduction on all the risks. So after that, we're going to talk about how to pick those risks. And we have a 10 minutes break. We come at 9:10. Then we go into how to pick the risk. Then I'll demonstrate to you how to find all this information and so that you can have a better trust on picking a risk. So I see everyone at 9 o'clock, 9:10. Hey, well, everyone. Say try why they need to call. Because Maui Novena is too expensive. It's too expensive. So no matter how much the separate, unless Parkway Life trading at $10, then maybe still I think even trading at $10 still need to call for right issues. Because the number of units they have is not a lot. Number of unit holder, they don't have so much. And Maui Novena, the values of Maui Novena, I think is the three hospital add together, the property value of three hospital add together is equal to Maui Novena. So indirectly they're buying something I can say they're buying another three hospital in that size. So how much to make, and these three hospital make up 60% of their income. So if they buy Novena, that means their income will increase by another 60%. So this is task is too big for them to swallow, and I don't think the sponsor want to sell them bit by bit. Not like Fraser's sponsor so good that always sell them bit by bit. You just buy little bit of Waterway Point, then after buy some more, slowly makan. On that, but I think hospital cannot buy bit by bit. Have to one time buy 100%. Okay, so this is why they can't take action on that. And we know that property value of Singapore will only keep on go up, and that's why Maui Novena will become more and more expensive. The later they buy, the property will become more and more expensive. It's at prime location. So that is this is why I think they are facing that challenge. That's my view on that. Why they still up now still cannot buy, and they may never buy if were to continue this way. When the property value become too high, how they don't even have money to buy. Okay, now let's look at why need to pick how to pick a REIT. Okay, first thing we look at something called a dividend yield. Okay, so what is a dividend yield? The example shown here is all past data. It's not the latest data. It's mainly for illustration purposes. As so, do take note. Don't look for a REIT. I always mention don't focus too much on high yield. There is always a reason why the yield is high, because this is how the formula of yield is being calculated. Distribution per unit over stock price. So the DPS over price. And the DPS is always based on what? Past 12 months. We call trailing 12 months. And the price is always based on current. Okay. So when the yield for the yield, when the REITs announce a bad result, for example, like cut dividends. When they say they have a cut in dividends, okay, what will happen to the share price? The share price will drop. And we know that when market talk about dividend, right, the price will always drop more than that. Just like you buy a stock, when they say XD, the share price will drop more than the dividend collected. So similarly, when they announce a dividend cut by this amount, the price will drop even more. And because of this, what will happen to the yield formula? The yield will go up. The yield will go up. So wow, this very high yield, but actually it's resulted from bad news. Cut dividend is something no good, and you go and buy something that is bad. Similarly, you look at Parkway Life. Why their yield is low? Okay, why their yield is low? Why is that so? Is that because the price will go up, the dividend go up, and the price will go up further, and thus the yield will come down, which is low. The logic is very straightforward. Is that, for example, you look at Parkway Life track record cost of dividend yield. Let's say if I were to buy Parkway Life now, example, if it's paying me 5 cents in dividends, and the price is trading $1. So my yield will be what? 5%, correct? Then next year, it increased to 6 cents. And what will my yield? My yield based on $1, I'll be having 6%, right? But will the share price stay at $1? No, the share price will not stay at $1. The share price will move up either to 120. So the person that buy from the market will still get 5% yield. Okay. Now that one more year ago was 0.07. So when I buy $1, my yield will become what? 7%. But will the share price go up now? Yes, the share price will go up. The share price will not go to 140. But 140, that means people will buy at 5% yield. The share price may will go up to 160. So when people buy, will be less than 5% yield. But why people still buy? Because people see that, last 2 years I have been increasing. So now even I buy a low percent, it's okay. As if next year they go to 0.08, my yield will just increase. Similarly, that just like if I go to 0.8, my yield will become 8% because I buy $1. So other people will see that, wow, this person is he so good, buy at $1. So now even the share price now is 250. People will still rush to buy because they are buying, hoping for the future, it will go to 0.9, 0.10 on that. And this is why their yield is low. This is why the yield is, and buying in the anticipation of future dividend increasing on that. So a lot of people just say that I want to buy REITs because of the dividend is high yield. You need to look at why some of the REITs that dividend the yield is low. There is always a reason for it, but BSG is not a good example on that because BSG can't even pay you the dividend and the share price drop, and thus the yield is also very low. But their dividend can't even make it. So that is something to take note. But and in current market juncture, a reasonable and also you need to look at market condition. So a reasonable dividend yield of about 5 to 6%, it is reasonable, except for Parkway Line Keppel DC. For normal REIT, anything that's giving 8%, 9% is unreasonable. Something is not right with the REITs. Please don't just blindly go and buy it, see that they are high yield. A good REIT now should range around 5 to 6% dividend yields. So that is one part. When you look at yield, please don't pick the high yield one. Unless the whole market crash, then that's different story. And next, it's called valuations. So valuation, we always look at something called a price to book, or some people call price over NAV. It's actually referring to a similar thing. So when the price more than NAV, we are called at a premium. When they're less than the NAV, we call it at a discount. Okay, a normal textbook will tell you that price less than MB, less than 1 is undervalued. We talk about that in the stock side, right? And also price more than 1 is called overvalue. Do think of this don't applicable for REITs. It's not applicable for REITs. You see, in general, when you see a REITs that are priced to book more than 1, you can imply it is a good REITs. And when the price is less than 1, you need to ask why. Why? Why it is less than 1? There is always a reason why they are less than 1. Okay. Because the market think that they don't deserve to be classified under this category. I put it very bluntly. The market think that they don't deserve to be on that. Who determine the market price? Is the big boy that determine the market price, not you and me. So don't think, oh, if I have cheap REITs on that. So please don't use this as a reference. And thus usually I prefer to buy REITs that are trading at a premium rather than this trading at discount, especially those trading at huge discount. This type of REITs, I'll just avoid them. For example, trading at what? Price to book 0.4, 0.5. Something is wrong with the REITs. Something is not right with the REITs. That type of REITs you should not buy. So how to look at that is you also need to know at their history of their price to NAV. And if they are constantly trading at a premium, then they drop down to near to their price to book across approximately 1 that time. Then and it's not their fault, it's due to over market sentiment that time, then you buy, then that is considered quite a good buy, good deal on that aspect. And most of the REITs that are quite a good deal at current market juncture, I would say that Ascenders will be quite, you see, I don't think Ascender will go below premium. So far, it don't happen, really happen. And in one stable rate like CICT or Fraser Centerpoint, usually they trade around price to book about 1 or 1.1. So market condition, if they drop below 1, go to 0.9 or even 0.8, to me, 0.8 is really a very good buy. If you look at entry as SCT and CICT, because they have to bounce back. They have bounce back to the datum of 1. That is a 20%. Okay, so they have the bounce back one. So this is how you look at the risk. For example, Parkway Life is always trading at very high price to book. But if they can drop even to 1.3, 1.5, you don't expect them to go to 1, it's a good buy already because they'll bounce up on that. So that's how you look at price to book at a premium and the discount. Please don't aim for I have one cheap risk. There is cheap for a reason. So that's how you look at price to book. The best is that you need to monitor the NAV over time. You roughly to know when is the good price to book entry price on that. Later I'll show you where to find out this information. And next, the ratios we're going to look at. First is the gearing ratio. Some people call it debt to equity ratio, but actually by right, it's supposed to be a debt to asset on that because over their total asset. So this should be supposed to be more towards the asset ratios in for risk aspect. But of course, for stock, you call debt to equity. And the gearing cannot be more than 50%. That's the MAS rules. But for risk, I'm looking at around 40. Actually, it's 35 to about 42%. That would be the gearing I'm looking at for a risk. Why too high is risky. It also shows that the manager have been taking too much risk, which I'm not comfortable with. They are a bit too aggressive. Too low, it means that the manager got difficulty in buying properties. If there's a difficulty in buying property, then there's a growth concern. Growth concern is not because they are prudent or what, it's that they can't buy. They want to buy also cannot buy. Because no manager want to make the gearing so low one. It is not beneficial to them because their income is lesser. Let's talk about the income. Their income would depend a lot on properties. The more property they able to buy, the manager will earn more money. Their salary will be more. They got more money to bring home. So if you are work for someone, don't you want to bring home more money? The incentive for you to bring home more money is to keep on buy properties. The more you buy, the more bonus you'll get. And whether it's good for unit holder is not important. But it's definitely good for you as a manager. And that's where alignment come in on that part. Okay, so that's on gearing aspect. I'm looking at 35 to about 42% range. And next is interest cover. Interest cover ratios, we talk about that in the stock, is the income they collected able to pay back how many of that interest. So I'm looking for more than 3. MAS have close to I to me is have make it very lenient for REITs to bring it down even to 1.5. Initially, MAS is 2.5, no? Now they remove this 2.5. They say simplify thing, make it even lower to 1.5. Actually, that will increase the risk of REITs. That will indirectly make some risk manager take more risk. And normal situation is okay, but when it comes to crisis time, a lot of REITs will suffer. So I suffer means that their share price will plunge and they may need to raise more money to rescue them. And thus, I still prefer to be more than 3. I think that will be a more prudent way of managing. And I think the good REITs, despite MS bringing it down to 1.5, they will try to maintain themselves above 3. Their own self-discipline on that, they'll try to maintain themselves above 3. On that, lower than 1.5 is to help those struggling REITs. If they don't lower, I think all these REITs will run into trouble. So MAS need to help them bring it down to 1.5. But even they bring in 1.5, they still can't help Lipo more. Lipo more now is 1.3. Okay. But 1.5 managed to rescue like Lendlease. Now it's 1.5. If they don't bring it down 1.5, I think Lendlease also will gone case. Well, Lendlease, if follow 2.5 Lendlease, they gone case. So now at least they save a lot of risks, rescue a lot of risks on that. And this is what we mean by interest cover ratio. And this is what we call, here you can see this is CICT. The interest cover ratio is 3.13. So I'm still looking at something that is 3 and above. If sometimes drop to 2.9, then you need to look at, is this just only one quarter, some issue, drop to 2.9 due to some interest rate fluctuation, then it's still okay. But next quarter, they're able to pull back to 3. But if 2.9, then drop to 2.8, then drop to 2.7, then this is the risk that you may don't want to touch already. Something is not right with the risk. So these two are a very, very important ratio when you want to buy a risk. You don't know what to buy, go and look at the interest cover. Is it more than 3 or not? It's less than 3. If less than 2, it better run. If less than 2, it better run. Don't even bother to touch the risk. Any black swan event come, the risk, right? This risk will crash. Okay. And the next one, very important, is the sponsor and the manager. So we need to look for a sponsor that have a very good alignment with the REITs, with the unit holder. You don't want a sponsor come in to dump property, which we have seen that before. They just come here to Singapore to get rid of their property so they can cash out their money. Then after just say bye-bye to Singapore's investor. Thank you so much for giving me the money. Okay, so we have seen that before in Singapore context. So you want to look for sponsor that is really come in and generally want to grow the REITs and generally want to benefit the unit holders on that. And the sponsor is very important is that when a REIT want to grow, they need pipelines. A REIT want to buy property. If the sponsor can't supply properties to the REITs, then the REITs will have trouble. Last time I talked to quite many years ago, there's one REITs come and do a presentation to the reminder. Usually quite funny one that let's share with you. We as a I am as a reminder, constantly there's some REITs, some company, listed company will come to Phillip Security to have a close-up meeting with the reminder to do a presentation. Their intention is to ask the reminder to promote their counter to ask their client to trade more. But you see that the company that come one will not be the big boys. The blue chip REITs don't bother to come. The big company don't bother. You see, it's the penny stock company. It's the struggling REITs that come because they hope that they can sell the idea to reminder to tell them to market the thing. So there's one REITs that come for the meeting, come for the sharing session, and happen to be these REITs. The sponsor is Temasek. The sponsor is Temasek. So it's very rarely to have a Temasek sponsor REITs to come and talk. But the issue of these streets is the sponsor is Temasek Link One, Temasek Link Company, but the sponsor don't do the business the REIT is doing. Anyway, it's over. You can just that for those that be aware that Ascender Hospitality Trust. Have you heard of? Some of you may heard of this REITs. Ascender Hospitality Trust. Ascender is under JTC, and JTC set up a hotel REITs. And JTC is industrial and they are sponsored for hotel REITs. So how are they going to support these REITs? So there's a question posed to the CEO of the REIT that how are the sponsors going to help you to grow? Then the REIT CEO answered in a very nice way. He just want to show that he's independent from the sponsor somehow. He said that me and the sponsor, just like we have a Great Wall of China in between us. In between us. So I don't know what's the sponsor thinking on that. Then how are you going to find your own REITs property? He need to find himself hotel because he need to go and find hotel himself. The sponsor don't have. So it don't seem to be a match on that. A strong sponsor, but the sponsor don't have pipelines. So ultimately, what happened to this Ascender Hospitality Trust? it go into now CapitaLand Escort Trust. So if may finally find a good place for it to land, find a sponsor that able to help him to grow. So it merged into Capital and Escort Trust. It being bought over by Capital and Escort Trust. Okay, so that is so a sponsor. You also need to make sure the sponsor must be in the same industry as you in order to help you to grow. If not, you also can't grow. So this is task when you choose a REIT sponsor, you must make sure that the sponsor must be in the property business. I prefer sponsor to be in the property business rather sponsor coming as an investor. Some investment company buy property then set up a REIT. That one actually I'm not so comfortable with because that there is to turn around the property and make money only. So you want to be a sponsor that are property developer. And there's this thing called income support. So this is something that I have to share is that when the REITs come to IPO in Singapore, first thing that they do not own any properties. They come to IPO in Singapore is to ask you to give them money to go and buy properties. But before you ask you to give them money, they need to give you a very nice picture. If not, you will never give them money. So one of the key things to give them nice picture is what project high dividend yield. There's even REITs that time project 9% dividend yield. Uh, so people will give money, wow, 9% dividend yield. But do they know the yield is not guaranteed? And how are the REITs going to develop 9% dividend yield when they even don't have the property? So they get the money from you, then they go and buy that properties already, then they manage and eat. Then they see can they develop give you the 9% dividend yield or not. So let's say for example the REIT tell you that I'm going to give you 9% dividend yield. But in the end they take your money, buy the property, in the end they can only deliver 7%. How? If they do give 7% in the first year, where the IPO promise you 9%, the share price will crash because they didn't meet the promise. People will lose confidence. So in order to prolong the thing, what they do, they still give 9%. But the question is, they can only get 7%. How can they give you 9%? A REIT's got no money one. And this is where income support come in. And coming from who? From the sponsor. The sponsor will say that I will put a sum of money with the REITs. If they cannot deliver this, I will top up 2% so that you as an investor get 9%. Okay, so that is called income support. So, but that means this thing is not real one. It's not a real one, but a lot of retail investors don't know. They say, oh, you really promised me 9%, you really give me 9%. But the risk manager really good, but actually the risk manager no good, they can't even deliver. And this income support will have a timeline, will last maybe first 3 years or last until the money finish. And when the money finish, the real thing will come in. And it really happened to one of the, actually it's more like to a business trust. After the support finish, the real true color show, they can't really deliver. And then dividend cut drastically. And the share price of course plus. But you only know that 3 years down the road. Because the first 2 years are still happily getting the dividend, but you don't know it's fake dividend. Okay, so that's called an income support thing. And and this is how it works. When we have support, then we support. And this is how this is just an example of how it works. So that is something to take note. And the next one is look for managers. The manager must have experience and also the fee structure. So this is how a sponsor is very important because they're able to provide support on that aspect. Yeah, yes, yes, it's under because it go under so how then one of the key reason how the one of the key reason to find whether the sponsor have interest with it is you need to look at this thing called this one. How you find this information? You need to go to the annual report. Annual report for behind look up, we look for this thing called substantial unit holders. on that. Okay, this is CapitaLand Ascendas. So you know CapitaLand Ascendas is under who? Under Temasek. So Temasek got how much percentage here? 19%. What is a sweet spot for a sponsor to have a stake in a REIT is 20%. Around 20 to 25%, to me, that is a good holding to show commitment the sponsor have with the REITs. With the REITs. Why is that so? Is especially for big REITs. Imagine Alexander is one of the big REITs. No? The market got 20% of the money inside. No? If Alexander were to fall, the market will lose a lot of money. So they have to make sure that these REITs don't fall. And thus, but if let's say the market only have 5%, so I don't think they bother so much about the REITs already. And then for the most they have to 5%, they channel their resource to people and focus on other thing. So this is where you want to look at interest, dim interest in that. And some of the REITs got less than 10%. Some of the REITs are sponsored have less than 10% interest in that. And that is the type of risk I don't even bother to touch because the sponsor are not interested one. They just put minimum stake and they themselves call sponsor, but they don't hold a lot of stake. So that is something you need to look at it. And there is a part that more doesn't mean good. So this one, another risk, also Temasek. But I look at how much you have. To me, this is too much. This is too much on that. They have too much stake on it. And the too much stake on it, what is the bad part of it? The sponsor will need to trim. They will have to trim one. As long-term wise, it is not economical for the sponsor to hold too much stake in the REITs and they need to trim. But how are they going to trim? If they were to sell, the REIT price will plunge. So that is a tough up. So this is why this REIT now suddenly I look at it, I wonder how are they going to trim? They cannot trim. There's no way they can trim. For those that are not aware, what is this one? This is Mapletree North Asia Commercial Trust. Okay, Mapletree North Asia Commercial. Why have so much stake? Because of the merger between Mapletree Commercial Trust and Mapletree North Asia Commercial Trust. The market buy at a very high cost price, and in fact, in a way that they are buying over from all the unit holders. So nobody want to subscribe for it, ma. So they take over. So in the end, they got so high stake. And how are they going to trim this? I also don't know how. Very different from CapitaLand REITs. CapitaLand REITs, CapitaLand Invest got CICT, got CapitaLand Escort Trust, got all these things like. And CapitaLand got quite a high stake in CapitaLand Escort Trust. Okay, but let's say Keppel Group, they got quite a high stake in Keppel REITs. For the know when there are Keppel REITs, I think at one time also go more than 50%. But they are able to trim. They are able to trim. Why? Because Keppel is listed. CapitaLand Invest is listed. So when they want to trim it, they give what? Dividend in specie. For those that hold Keppel shares and for those that have CapitaLand investment share, you may have seen that before. That suddenly, how come you got Keppel REIT shares? How come you got CICT share, the latest one? For those that hold CapitaLand Invest, they got CICT share. They give you the shares for free as dividend. So this called dividend. And then from there, they can trim their stake. They can trim their stake down to a healthy stake. But for Temasek, for Mapletree Group, they are not listed. They are not listed. So how are they going to trim? I really don't know. Okay. So that's the part that I'm still thinking on and on this. And because of the sponsor got too high a stake in it, and then people worry about the sponsor that got too much controlling stake also, it may affect the risk performance also. So this is so too high also not that good. Okay, too high also not that good in a way, but it's better than but so much better than No little. Too high means they got a lot of interest. No? Mapletree North Asia Commercial, if you were to go bust, 50% is the market money. Oh. So they'll die will not make sure the bad die cannot make sure they will not go bust. Hey, this is I don't like this type of illustration. I don't like this type of illustration. For that, don't know this is you look at this, who is the sponsor? Anyone can guess? Okay, anyone can guess who is the sponsor for this REITs? And what REITs is this? CDL. CDL is just one of the sponsor. This REIT got two sponsor. Okay, this is one and CDL is the other one. So this REIT come with two sponsor. So it's not a single sponsor REIT. I mean it's two sponsor. So it also means one thing, the sponsor can fight. Yeah. Two company is a joint venture in a way. And CDL is a new sponsor. CDL take over another sponsor. This is iREIT Global. For you know, this is iREIT Global. Last time there was another sponsor. Then he sell the stake to CDL. So CDL come in to that together. So they got two sponsors. Why I don't like this type of layout is that where is the percentage? You can see here, calculate for you, right? So why they just don't want to add one column to make it easy for investor to take a look at that. So sometimes I see this stuff, I got a bad impression of REITs indirectly because they are not investor friendly. To add in a column is not difficult for them, but for investor to go and manually go and calculate the weightage is troublesome for investor. How to calculate? First, you must know how many units are they being distributed in these REITs. And from there, you need to take this punch your calculator to divide by that, then you know the percentage. So to investor, it's a bit troublesome. But to the REIT manager, to annual report, you just need one column only. And they just refuse to do that. So this is why I don't like. Some of the REITs like to do that, which I don't like. Suntec REITs is an example, typical example. You don't put anything on. You want to know, you count yourself. Which I don't like that REITs. In the way they present it. Okay. Someone asked what is the direct interest and what is the dim interest. Okay. Direct interest means that the share is held directly under your name. Let me just use Temasek as an example. Harbourfront Private Limited is a company. You go to CDP to check, you have this number of shares under their name. Okay. Harbourfront Egg, you go to CDP to check, they got this number of shares under their name. But you cannot find Temasek inside the CDP name. Temasek got 0 shares. Then you see, how come Temasek got 0 shares? But is you here telling me got 56%? Why? Because all these company right here are owned by Temasek. And thus, Temasek have this interest in that. So if this Harbourfront, if want to sell the share here, right, the instruction must come from Temasek, hey, go and sell. Then they can sell. The management would not dare to just press the button to sell. The order must come from Temasek because they are the boss. So this is what I call NIM interest and direct interest. So direct interest add together, everything all together will be 100%. Because these are the share recorded in CDP under their name. NIM interest is indirectly on that. Okay, and so that's how NIM interest and that. So always look at finally the top one who have real control. Okay, this is just another example of a stake. So this is ESR. So it means how come there's a name here? And he puts first some more. I think they never change. This person, the name always on the first. So he only have 5% stake, so very little. If you follow ESR, for those that follow ESR annual report, you go and trace back their annual report in the past few years, you see that this person, the stake have been reducing year on year. Before that, his stake is more than the sponsor. Before that, his stake is more than sponsor. That means that the sponsor listen to him. But along the way, he start to trim his stake. But anyway, this company I think belong. I don't know, and him got link one. Okay. So he start to trim his stake. So last time I look at ESI, I'm not comfortable with buying at all because he is the one that determine the risk, not the sponsor. But along the way, he start to trim the stake. For those who don't know who is this person, he's just one of the property tycoon in China. So last time you can take it that ESR buy only property in Singapore last time before all the merger. You can take it that a property tycoon in China come to set the risk and start to buy Singapore industrial building. But now his stake has started to come down due to some merger and acquisition along the ESR group itself. So the sponsor ESR now got 20% stake. So you see this thing will start to change and risk will start to evolve. So you, in a way that you need to monitor in this aspect. Okay, so these are the key fact you look at risk and but where to find all this data, as this data you can find on the annual report for this one. What about the rest? Where to find it? Let me just demonstrate to you how to find this data. Let me just go to where is. Okay, let's just look at one example. For example, you go to so for risk, where to find those informations, you must always go to their website. Don't go to SGX. SGX don't give you good information for risk analysis. Unfortunately, so let's say I talk about Ascender. So that Ascender is go to their CapitaLand Ascenders, go to their website. Anyway, this is recorded. You can always go and replay the video. So when you come to the risk website, there's this thing called about the manager. You can see what you like. Our portfolio will tell you what property they have. So you can also see from here also, as I mentioned, size really matters when it comes to REITs. Number of properties, 229. To me, is a good size in Singapore context. How big is the REITs? I always look for this word billion. I don't look for million. When you want to buy a REIT, you need to look for billions, not millions. Okay, so the asset management must be billions. And another thing I look for billions is called market cap. Market capitalization. Market capitalization must be also in billions. Okay, this is size. Size really matter. Asset under management can be in billion, but the market cap can be in millions. Why is that so? Because the share price drop. The share price not strong enough. The number of units not good enough. And this is why their market cap will drop into million. So I will not interested also. So I want billions. So billions in market cap, billion in asset under management. Then property, of course, it need to be a lot. For industrial building, more than 100 should be the norm. For shopping mall, you don't expect that more than 10 is considered very good already. Shopping mall, more than 10 is considered very good already. You don't expect your REITs to buy 100 shopping mall. Very hard, almost not possible for Singapore. If they can buy 100 shopping mall, they'll be the biggest REIT in Singapore. Similar for office building, you don't expect them to buy 100. Can get 10 is considered very good because it's expensive. So this is where you can see their size. And when you go in, more important thing, you go to this thing called investor relation and look for this thing called financial information. And what I want is look for this thing called financial result. And one of the financial result, there's always this thing called presentation slide. And you see, they every 6 months then they give you more detail on the financial statement. So I would prefer to, I don't want the business update. I don't want the business, I want to look at their finance. So you look to a presentation slide and you can click on the presentation slide and look at their presentation slide. And do take note, the word presentation, it means that they want to present to you. And in a nutshell, is presentation side means that what they want you to see. What they don't want you to see will definitely not be in the presentation slide. And of course, what they don't want you to see is not all the bad things. Of course, then they will not be there. But some of the things that is bad one, but they still need to show you because they got no choice because regulation. Then they'll try to put in a way that it don't look bad. Okay, and hope that you don't spot it. So please don't take it as a face value on that. And so you see on the presentation side, what I want to look at is you see the key part is this thing called capital management. And this is the one that you want to focus on. Focus on the capital. Of course, the rest financial performance it's good to know. Below one, you say I don't bother. Then you go inside, you look at all these things, disclaimer, key highlight will tell you. So key highlight usually will tell you the good things. Then financial highlight, all these things will be definitely good. Then financial performance. So what I want to look at. So I just want to emphasize on one thing. This is a full year thing. You can see this is called number of units. Yeah. And for financial year 2023, the number of units they have is 4.3 billion. Okay, 4.3 billion unit. But for financial 2024 is 4.39 billions. So that is something you will always see in REITs. The units keep on increasing one. The units will keep on increase every year. So imagine you buy a standard REIT, you buy 10,000 and you never do anything. So your number of holding at 2023, your number of percentage will be 10,000 divided by this 4.13 million. That will be your that's your weightage. At 2024 will be what? 10,000 divided by 4,399 percentage. Million. Okay. So what does this tell you? A lot of people say that this is what I call dilution. Dilution in a way that your stake in the REITs become lesser. By doing nothing, your stake in the REITs become